Corporate finance practice problem using OneNote. Cash flow impact of depreciation due to taxes. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, down here in the 1213 Cash Flow Impact of Depreciation Due to Taxes tab. Also note, when using OneNote, take a look at the immersive reader. Many of our presentations will be mirrored in the text area with the same name, same number, having transcripts that can be translated into multiple different languages and either listened to or read in them, making them a good complement to the presentations. Closing out the icon up top, information up top, calculations down below in the blue area. We're looking at the cash flow again, this time focusing in on the change in the depreciation, imagining a situation where we have no depreciation and one in which we then do have depreciation, and that'll be down here, so that we can then have, and that'll be a maximum of the depreciation, so that we could see the impact of it in terms of the taxes. So remember the idea here, as we saw in a previous problem of a similar fashion, we're kind of considering the cash flow as if we're doing a large type of investment in terms of thinking, as we'll go forward in this section, of a long-term investment that we're going to imagine will generate future cash flows. What will be the impact of depreciation on it? Depreciation being something from an accounting standpoint that is not lining up to the same point in time when cash was paid for an investment in, say, equipment, building, and so on and so forth. So when we're thinking about projections into the future, we're typically doing so on more of a cash flow type of basis, trying to present value the cash flows. When we're thinking about financial kind of reporting, we want to be matching up the depreciation when it's consumed to when it has been used. So normally we would remove it for a cash flow type of calculation. However, there is a cash flow impact due to the fact that if that depreciation is taxable, then we need to take into consideration the tax impact, which will be a cash flow type of impact. So here's going to be our analysis. We got the earnings before depreciation and taxes, 100,000. We'll first assume that there is no depreciation, and then we'll maximize the depreciation to see what the maximum impact would be. Tax rate will stay fixed in our two example problems at the 35 here. So the change will be the depreciation and the tax on it, same rate and same earnings before the depreciation. Then we're going to say the cash flow calculation first will be the earnings before depreciation and taxes. And then we're going to say that depreciation is 0 this time. Therefore, we have no earnings before taxes. So we're going to have the earnings before taxes of the 1 million, the same number, because we removed, or we don't have any depreciation here that we're adding. Then the taxes, it's going to be the 3,500, which would then be that 1 million times the 0.35. So the 1 million, let's just do it for fun. 1 million times 0.35 would be 350 on the taxes. The 1 million minus the 350 would be the 650,000. And then if we added back the depreciation, which there was none, we would have the 650. Now let's compare that to our second example where we have depreciation equivalent to the earnings before depreciation and taxes. So we have depreciation of 1 million, tax rate the same. So this depreciation does not reflect necessarily cash flow, but it does have a tax impact, or it has a cash flow impact because it has a tax impact, possibly. So now we're going to say, all right, let's start at our same starting point, the earnings before depreciation and taxes, the 1 million. Now we're going to take the depreciation, also 1 million, and that's going to be reduced. The only reason we are reducing it with this cash flow calculation is not because cash is affected, but because it has a tax impact. Then, of course, if we take 0, which is our earnings before taxes, taking into consideration the depreciation times 35%, we get 0. And then we have our earnings after taxes, which is still 0. But then we would add back the depreciation of the 1 million. And the reason we're doing that is because the only reason we took it out, because we're doing a cash flow calculation, isn't because it's cash related, but because it has a tax impact. So if we add that back in, we've got the cash flow of then the 1 million. So the difference between these two calculations, we had up top the 650,000 and down below we've got the 1 million, that difference being the 350,000. That difference due to the tax impact of the depreciation. So it's always something you want to keep in mind, especially when you're looking at these projections out into the future. What is going to be the impact of the depreciation? How can we look at it from a cash flow perspective, possibly, so that we can present value our cash flows, which typically means we remove the depreciation, it being an adjusting entry without a cash impact to it. But we do have to do the cash flow consequences of a tax impact on that depreciation and make sure that we take that into consideration, because it can indeed, of course, be significant.